if I search YouTube for trading win rate, these are the kind of results that appear. 88% winning rate, 86% win rate, 96%, 99%, and the list just goes on and on and on. But is it possible to have a high win rate like this? The good news is, yes, it's possible. And some of those systems may actually have those win rates. But does that mean that they are profitable? Well, not necessarily. Hi everyone, I'm Pedro, and today we are going to learn how to evaluate the profitability of a trading system the right way so that you don't fall into traps. So guys, one of the members of my trading chat room asked me this question recently. How much is the win rate of a profitable trader? And this is a question that I see asked frequently. To answer this question, we need to know three different things. Let's see what they are, how do you use them together to know if a strategy is profitable. In the end, I'll give you a calculator that you can use to make things simpler, and I'll also give you a final bonus tip with a different way of using the winning rate that you can implement right now on your own trading strategy. Let's start with the first thing, the win rate itself. The win rate tells us the percentage of winning trades, the percentage of trades that are profitable. So, if our win rate is 50%, we are getting 50 wins and 50 losses out of 100. If our win rate is 80%, we are winning 80 trades and losing 20 trades out of 100. If our win rate is 35%, we are winning 30 times out of 100. Pretty simple, right? Now, we also need to know how much do we win on average on a profitable trade, and how much do we lose when the trade goes against us. And this will be the second item that we need to know, and it's called the risk-reward of the strategy. Typically, for any particular trade, you should risk the same amount of money, a fixed percentage of your account. So let's say that you risk 1% of your account per trade. And by the way, this 1% of risk per trade, which is a common rule that almost everyone suggests to use, I'm completely against following that blindly. But that will be a talk for another video. So anyway, if you risk 1% of your account and on average you get 1% return, you have what it's called a 1-to-1 risk-reward. 1% risk and 1% reward. Now, if you risk 1% of your account and you get 2% back when you win a trade, you get a 1-to-2 or 2-to-1 risk-reward. Usually people call it 2-to-1, but in my opinion it makes more sense to call it 1-to-2, no? Since we are talking about risk first and slash reward, so it's 1 risk and 2 reward. Do you guys type the risk or the reward first? Let me know in the comments your opinion about this. We can also have the risk bigger than the reward, like we can risk 3% on every trade to aim to win 1% on every trade. And when the risk is bigger than the reward, it's often considered a bad risk-reward ratio. I wouldn't say it's necessarily bad, but it will probably affect you psychologically. So if you risk $3 to win $1, it means that you need 3 profitable trades to recover 1 single loss. While if you are risking $1 to make $3, you can recover up to 3 losses at once with 1 single trade. Now, let's put the winning rate and the risk-reward together with some examples. And for that I have a spreadsheet that will help us and that I'm going to share with you at the end of this video. Guys, if you are liking this video so far, don't forget to hit the like button. That will help me to stay motivated to create more videos like this. So let's look at the spreadsheet and let's start by using the 90% winning rate example. So if we have a 90% winning rate, we also have a 10% of loss rate. And let's say that our risk reward is 1-to-1, meaning that we risk $1 to get $1 of return. How much are we going to get in the long term? This is simple math, guys. So let's say that in 100 trades, we get 90 trades where we have profit, and then we multiply by $1. This means that on our winning trades, we are going to win $90. And if out of 100 trades, we get 10 losses, and then we lose $1 on every trade that we lose, we end up getting a total of $10 of loss. And how much do we get in the end? $90 less 10, we get $80 of profit for every 100 trades. And this is what we have here. But guys, the thing is that when we have a 90% win rate, very hardly we are going to get a one-to-one risk reward. Most of the times to get a huge win rate like this, they are kind of like risking $10 to win $1, to make $1 of profit. And what's the return? They are actually getting a loss after 100 trades. Now let's look at another scenario. For example, if we have a 50% winning rate and the risk reward 1-to-1, it means that in the end we don't win or lose anything, because we have 50 trades where we win $1 and 50 trades out of 100 where we are going to lose $1. So in the end we have zero. But if we increase our reward, then let's say that we are going to aim for $2 in profit for every $1 that we risk, after 100 trades we get $50 of profit. And now let's look at an extreme scenario. Imagine that we have a strategy that only wins 10% of the time. It means that loses trades 90% of the time. In this scenario, we have to go to something like 10 reward to every $1 of risk, at least, to pass the break-even point and start getting some profit. So, and what kind of strategies are these? These are the strategies that you risk just little small amounts, very small patterns on your charts, but then you go for very long targets, for very big targets. So you are aiming for a 10 times reward compared to your risk, but you are only going to win a small amount of times. But every time that you win, you are going to make a big return. You are going to cover a lot of losses and even get a profit on top of that. So guys, you can see that a 10% winning rate may not necessarily be a bad thing. And if you can win instead of 10, if you can win 11, you double your result after 100 trades. Guys, I still have a bonus tip that I want to give to you that you can implement in your trading strategy right away. But before that, we still have point number 3, and that is your common sense. Use your common sense to analyze everything. If something looks too good to be true, it's because probably it is too good to be true. There are no systems with a 95% win rate and a 2-to-1 risk reward, or even a 1-to-1 risk reward. If someone is presenting you with such a system, be careful with that, because something stinks in there. And there are a lot of good trading systems that work, but there is no holy grail that will make you rich in a short period of time. When you stop trying to find the holy grail system and focus on what's the reality of trading, that's when your chances of being successful as a trader start to increase, and you'll actually have a chance to survive in this world. Guys, look at this example. This guy claims that his system has a 97% win rate, and in 10 years it went from $300 to $50 million. 50 million starting with $300. How crazy is that? And now look at the equity curve. When you see a graph like this, believe me that this is one of those things that they are too good to be true. And you'll see a lot of charts like this if you search. All of these are backtests, and they are made with robots, guys, and they can be manipulated. Once, someone shared with me a robot that would detect the momentum of a movement starting based on ticks. So when the market started to print fast ticks like this going in one single direction, the robot would open a trade and then try to catch the continuation of this momentum. But the thing is, when I backtest the system, the robot showed me an equity curve similar to this. But then I went to use that robot with a demo account, but using live market data, and the robot failed completely. So instead of having like 19% of winning rate, it only had around 10% or something like that. And why? Because the backtest was made using virtual ticks. This is the default way of using your MetaTrader platform, and you can even see here at the top that it says explicitly that generates each tick. So the platform kind of creates ticks based on the candle shape. So if you have a bull candle like this with a wick at the top, at the bottom, and another wick at the top, your candle will have, I think it's 4 ticks. So you have the first tick, which is the open, it's here. Then it assumes that the candle went down and printed the second tick, and then assumes that the candle made the high and prints the next tick, making something like this, and then the last tick is the close of the candle. So in real, your candle only had 1, 2, 3, 4 ticks, when in fact the price may move a lot of times up and down until the candle closes. And that made the robot fail miserably when trading with live data. Another example of fake systems are the arbitrage robots. Arbitrage is something that works, but it's not accessible to a retail trader like us. There are companies that have algorithms for arbitrage trading, and they actually make millions or billions, but they also spend hundreds of millions to be able to do that, building their buildings the closest possible to the exchanges with ultra fast direct connections to the exchanges, and the company that is able to be physically located just 1 mile or 1 kilometer closer to the exchange, that will be the one that will win the arbitrage game. Not someone like me and you with a simple trading platform and what we believe is a fast internet connection on our computers, thousands of miles or kilometers away from where the trades are processed. So guys, always be careful with these kind of systems that seem too good to be true. And now my bonus tip. Guys, I want you to think in terms of days, not trades. And let me explain. There are days that are really terrible to trade. The market doesn't move, it's just choppy and sideways. And on days like this, your best move is to stop trading and wait for the next day. Otherwise, you may end up the day with a 10% winning rate and a terrible risk reward. And you don't want that, right? On the other hand, there are days that are great to trade. A lot of volatility, a lot of clean moves. All the setups work perfectly. These are the days where you can get a nice reward from trading. I don't mean that you should trade like crazy because you'll end up messing everything. You simply take your couple of trades and your day is done with a nice profit. Now, the secret is you can't ever let your red days go into deep red. You should stop trading quickly when you see that the day is bad. And what's the result? When a good day comes, you'll be able to easily cover your losses and even get some profit on top of that. So let's say that every week you have 2 red days and 3 green days. That's a 60% win rate in terms of days. And if you don't let your red days be bigger than your green days, you are good to go, you are already profitable. Let's even say that you lose and win the same amount on every particular day. For example, on a red day you lose 2% of your account, and on a green day you make 2% of your account, winning 3 trades out of 5 every week. You are making 2% of profit per week. 8% of profit per month if we consider that we have 4 weeks in 1 month. Guys, 8% per month is an amazing result. And what I want you to do from now on is to forget about the winning rate in terms of trades, but think of it in terms of days. That will make you see things from a different perspective. It will take a lot of pressure from you and hopefully will make you a better trader. And if you want to learn even more, in the description of this video there is a link to my website where you can register to get an exclusive 6-day free trading course. Guys, if you like this video, I would really appreciate if you could leave a thumbs up and a comment. And if you enjoy this kind of content, consider subscribing to the channel and activate the notification so that you get notified every time that I release a new video. And I'll leave the link to the spreadsheet also in the description of the video. A big thank you to all of you who support me and see you soon in the next video.